How can you turn thousands of dollars into millions without relying on extraordinary intelligence? Why does Warren Buffett call one book the best investment guide of all time? And what hidden connection exists between psychology and successful investing? Stay with me till the end to uncover timeless principles that could set you on the path to financial freedom. Introduction. Successful investing does not require a genius-level IQ, insider information, or mere luck. Instead, it demands a sound intellectual framework for decision-making and the discipline to prevent emotions from undermining your strategy. These principles are precisely what Benjamin Graham, the father of value investing, offers in The Intelligent Investor. His methods have stood the test of time and remain among the most successful investment strategies in history. Takeaway 1. Meet Mr. Market. Imagine owning a share in a business valued at $1,000. Each day, a bipolar individual named Mr. Market arrives at your door with fluctuating opinions on the value of your investment. Sometimes he quotes an absurdly high price, while other times he undervalues it dramatically. Should you let this eccentric figure dictate your decisions? Of course not. Graham teaches us to see stocks as ownership stakes in businesses rather than just symbols on a ticker. Mr. Market's irrational optimism or pessimism often creates opportunities. Sell to him when prices are inflated and buy when bargains appear. This mindset protects investors from emotional reactions to market volatility. Key takeaway 2. Defensive investing. Graham categorizes investors into two groups, the defensive and the enterprising. Defensive investors prioritize safety and simplicity. They should diversify their portfolios across 10 to 30 companies, ensuring no single industry dominates. Focus on large, stable companies with a history of paying dividends for at least 20 years. Maintain a balanced portfolio, such as 50% stocks and 50% bonds, rebalancing periodically. Utilize dollar cost averaging by investing fixed amounts at regular intervals, ensuring purchases occur across different market conditions. By following these rules, defensive investors can achieve steady, predictable returns while avoiding the pitfalls of speculation. In the next section, we'll delve into the strategies for enterprising investors, uncover the importance of margin of safety, and explore techniques to analyze company valuations. Don't miss it. Part 2. The enterprising investor and margin of safety. While the defensive investor focuses on simplicity and stability, the enterprising investor aims for higher returns by taking on more responsibility and risk. However, outperforming the market requires patience, discipline, and meticulous research, a challenge few can consistently master. Key takeaway 3. Strategies for the enterprising investor. To beat the market, enterprising investors must avoid overvalued growth stocks. Glamorous stocks often carry inflated prices based on speculative future growth. Instead, look for undervalued companies. Seek bargain opportunities. An ideal find is a company trading below its net working capital. This means you essentially pay nothing for fixed assets like machinery or goodwill. While rare, such opportunities can be highly profitable, particularly during bear markets. Embrace detailed analysis. Study annual reports and financial statements. Graham's book, The Interpretation of Financial Statements, serves as an excellent resource for understanding company data. Enterprising investors must also exercise caution and remain skeptical of market trends, ensuring decisions are rooted in logic rather than emotion. Key takeaway 4. Insist on a margin of safety. Investing always involves some degree of uncertainty, but Graham offers a remedy: the margin of safety. This principle states that investors should buy assets priced well below their intrinsic value, creating a cushion against errors in judgment or unforeseen events. For example, if a company's calculated worth is $30 per share, buying it at $20 ensures a buffer for potential miscalculations. This approach minimizes downside risks while maximizing long-term gains. Graham provides a formula for valuation. By applying this formula, investors can estimate a stock's intrinsic value and identify whether it's trading at a discount. Modern implications. Although Graham's techniques originated decades ago, they remain relevant in today's market. However, opportunities like undervalued stocks and high margins of safety are rarer now, requiring even greater diligence. In the final section, we'll discuss the intricate relationship between risk and reward, challenge conventional investment theories, and wrap up with actionable insights for your investing journey. Stay tuned. Part 3. The relationship between risk and reward. Modern investing theories often claim that risk and reward are inherently correlated. Higher risk leads to higher rewards. However, Benjamin Graham challenges this notion, emphasizing the disconnection between price and value in the stock market. Let's dive deeper into this unconventional perspective. Key takeaway 5. Risk and reward are not always linked. Academic models suggest that volatile investments should yield greater returns. Graham, however, argues that the stock market doesn't adhere to such predictable patterns. Instead, successful investing is about identifying undervalued assets where the potential reward far outweighs the associated risk. For example, buying a company valued at $1 for 60 cents inherently carries less risk and greater upside than paying 90 cents for the same asset. By focusing on price-value discrepancies, intelligent investors can maximize returns while minimizing exposure to unnecessary risk. Lessons from the Russian roulette analogy. Imagine being offered $10,000 to play Russian roulette with one bullet in a 6-chamber revolver. Adding more bullets increases the potential reward, but also heightens the risk dramatically. Graham uses this analogy to illustrate the flaw in chasing high-risk opportunities. Instead of gambling on uncertain rewards, investors should seek undervalued assets where the odds are in their favor. Summary of key takeaways. Mr. Market. Treat the stock market as a tool for buying and selling based on rational valuations, not emotions. Defensive investor. Opt for stable, diversified portfolios with consistent, low-risk returns. Enterprising investor. Pursue undervalued stocks with discipline and patience, emphasizing rigorous analysis. Margin of safety. Always invest with a significant buffer to mitigate risks. Risk and reward. Reject the myth that higher risks automatically lead to greater rewards. Focus instead on undervalued opportunities. Are Graham's ideas still relevant? Despite originating in the 20th century, Graham's principles remain crucial in navigating today's complex and volatile financial landscape. While technology and information access have changed the game, the core ideas of rational investing and emotional control are timeless. Closing thoughts. Success in investing and personal finance is not merely about luck or isolated good decisions. It's about cultivating habits that consistently lead to better outcomes over time. Here's why reading, analyzing, diversifying, and self-improvement are non-negotiables for financial success. Knowledge is the most powerful tool for any investor. Reading books by financial visionaries such as Benjamin Graham, Warren Buffett, or Morgan Housel provides a solid foundation. These works reveal timeless principles and strategies that transcend market cycles. Every book you read sharpens your understanding of market dynamics, teaches you how to evaluate businesses, and develops the emotional discipline needed to succeed. Treat reading as an investment in your mind, and the returns will manifest in your financial decisions. Markets are complex ecosystems influenced by countless factors, including economics, politics, and human psychology. Developing the ability to interpret and critically analyze information equips you to navigate these complexities. Regularly reviewing company reports, market trends, and macroeconomic data helps refine your decision-making. Remember, the goal is not just to follow trends, but to anticipate opportunities where others see uncertainty. The financial landscape is ever-changing, with new technologies, markets, and opportunities emerging constantly. Staying informed and continually enhancing your skills ensures that you're not left behind. Take courses on financial planning, stock analysis, or portfolio management. Attend seminars or webinars led by experts. Learn from mistakes, yours and others, and adapt. Each step forward in your education enhances your ability to make sound financial decisions and build wealth. Remember, financial success is a journey, not a destination. Commit to reading, analyzing, diversifying, and learning. By cultivating these habits, you not only secure your financial future, but also empower yourself to achieve greater freedom and opportunities. If you don't invest in yourself, who will? Take the first step today. The insights from The Intelligent Investor serve as a roadmap for achieving financial success through methodical and disciplined investing. What do you think about these principles? Are they still applicable in the modern market? Share your thoughts in the comments. If you found these takeaways valuable, don't forget to like this video, subscribe to my channel Karakin, and turn on notifications. Here's to your success. Happy investing.